In 2020, it did it again. Buying corporate bonds, pumping liquidity into markets, and inflating asset bubbles that made the rich richer, while everyone else was told to wait for trickle-down. This is the deeper truth. Central banks don't just control the economy, they shape it. They choose winners and losers. When they cut rates, stocks soar. When they tighten, markets crash. When they print money, asset holders get rich. When they raise rates, the working class pays more for mortgages, credit cards, and car loans. And while they claim independence, central banks are entangled with the very financial system they're supposed to oversee. Their leaders rotate in and out of investment banks. Their policies often mirror the interests of Wall Street, and their language, intentionally vague, wrapped in technical jargon, keeps the public in the dark. Today, we live in a world where central banks are more powerful than ever and more unaccountable. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, these are not neutral institutions. They have become the unseen architects of our monetary reality. And since 2008, they've transformed the economy into something barely recognizable. Low interest rates became the norm. Quantitative easing, a once unthinkable policy, became routine. Central banks printed trillions to buy government bonds, corporate debt, even mortgage-backed securities. And the result, asset prices soared, stocks, real estate, commodities. For those who owned assets, it was a golden era. For everyone else, it was inflation disguised as prosperity. Housing became unaffordable. The stock market decoupled from wages. The cost of living rose while savings earned nothing, and most people had no idea why. Now, beyond the curtain of modern civilization stand the central banks, silent institutions few were ever encouraged to question. They seldom seek the spotlight. They rarely face elections, and most people can't explain what they actually do. But central banks control the price of your money, the fate of your economy, and the value of everything you've worked for. With a few quiet decisions, they can summon wealth from nothing, or make fortunes fade overnight. And the strangest part, they don't really answer to you. This is the hidden chronicle of how central banks came to rule modern finance, not as neutral referees, but as active players in a game they helped invent. It's a story of veiled power, monetary alchemy, and a carefully crafted illusion of stability. And once you understand how it all started, you'll never see your paycheck, your debt, or your savings the same way again. Let us return to the year 1694, where the first threads of this invisible web were woven. England was broke. The crown had just fought an expensive war against France, and the treasury was empty. It wasn't a bank like we think of today. It didn't exist to serve citizens. It existed to fund the government and profit from doing so. That's the origin of the modern central bank, not as a stabilizer, but as a lender to the state. And over time that power only grew. By the 19th century, central banks across Europe had adopted similar models. Privately owned institutions with special privileges. They issued currency. Time lapse off. They controlled reserves. They bailed out governments in crisis. And in return, they gained extraordinary influence, often without democratic oversight. In the United States, the story took a rockier path. Americans were deeply skeptical of centralized financial power. The first and second banks of the United States were both shut down after political battles over corruption and elitism. For much of the 19th century, the U.S. had no central bank and the financial system was a wild mess of private currencies, speculative manias, and violent panics. But after the Panic of 1907, a crisis so severe that private financier J.P. Morgan had to coordinate a rescue himself. The pressure mounted. In 1913, Congress passed the Federal Reserve Act, creating the Federal Reserve System. It was pitched as a decentralized network of regional banks that would stabilize the economy. In practice, it became a central authority with immense power over interest rates, credit, and money supply. And here's where the story gets murkier. The Federal Reserve isn't a government agency. It's an independent entity with public and private elements. Its board is appointed by the president, but its member banks are privately owned. It's funded not by taxes, but by interest on government debt and the fees it charges banks. It operates in the shadows of financial markets, making decisions that affect millions without any real voter input. So, who does it serve? Officially, the Fed has a dual mandate: maximum employment and stable prices. But unofficially, its actions often benefit the same institutions it was meant to regulate. During the 2008 crisis, the Fed didn't just cut rates. It printed trillions, bailed out investment banks, propped up asset prices, and guaranteed toxic debt. They blame politicians, immigrants, bad luck, but not the invisible hand guiding the money supply. Here is the deeper truth. The modern financial system is designed to keep you in motion, not to set you free. Central banks grease the wheels of consumption. They reward debt. They punish saving. They manipulate rates, control narratives, and move trillions with the stroke of a keyboard. And all of it, every meeting, every press release, every emergency intervention is framed as stability. But it's not your stability they're protecting. Because the game is simple. When things break, the central bank steps in to save the system, not the people. The system, the banks, the asset holders, the machine. Look at what happened in 2020. The COVID crash triggered the fastest collapse in market history. Within weeks, the Federal Reserve unleashed more than $3 trillion in new liquidity. Stocks rebounded. Billionaires doubled their wealth. But millions of workers lost their jobs. Small businesses died. Renters faced eviction. What was saved wasn't the economy. It was the illusion of strength. The balance sheet expanded. The debt grew. And the cycle of dependency deepened. And this matters because when central banks distort the cost of money, they distort everything. They make it harder to price risk, harder to save, harder to retire. They fuel bubbles. They trigger crashes. They create a roller coaster economy where real wealth is elusive and paper profits vanish overnight. And worst of all, they remove agency. Most people don't even know they're being affected. They don't realize that the interest rate on their student loan, the return on their savings, the price of their house, it is all downstream of decisions made in rooms they call never enter by people they'll never vote for. So, who controls central banks? Officially, they're independent, but in practice, they serve the system that birthed them. The banks, the markets, the entrenched financial class, the revolving door between Wall Street and central banking isn't a conspiracy theory. It is a resume pipeline. And the language of central banking, the obfuscation, the academic tone, the technical reports, serves one purpose: to keep outsiders out. But you're not an outsider anymore. Because once you understand how the financial system is structured and how central banks enforce that structure, you can start to break free. Financial education isn't just about budgeting or investing. It's about power. It's about knowing that money is not neutral, that inflation isn't random, that interest rates are political, that freedom requires understanding the system and stepping outside of its traps. That might mean holding assets that can't be printed. That might mean building income streams not tied to debt cycles. That might mean rejecting the idea that prosperity only comes from growth. Because growth fueled by endless debt and constant consumption is a treadmill. And the faster it spins, the harder it becomes to stop. So what can you do? Start by seeing clearly central banks are not gods. They're players. And their tools, interest rates, liquidity injections, asset purchases are not designed with your freedom in mind. They're designed to stabilize markets, protect institutions, and preserve the architecture of a fragile debt-fueled economy. You can't fight that system directly, but you can position yourself outside of its reach. Diversify. Simplify. Deleverage. Own things that matter. Learn how money works. Teach others. Question the narratives. Because when the next crisis comes, and it will, the central bank will do what it always does. Protect the system. Your greatest safeguard is understanding. History doesn't repeat. But if you don't understand it, it'll crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.